Let me guess. You want to start investing, but are not confident or experienced enough to pick individual stocks. So you did your research and found an alternative way. ETFs. In case you didn't already know, an ETF's main function is to replicate the performance of the index or sector they track. ETFs offer several advantages over traditional mutual funds, including lower fees, greater flexibility, and greater liquidity, as they can be bought and sold throughout the day on an exchange. While conducting your research, you likely came through the two most famous ETFs. You just cannot go wrong with them. These are the S&P 500 and Nasdaq. They each represent different segments of the U.S. stock market. The S&P 500, introduced in 1957, tracks 500 large-cap U.S. stocks and is diversified across 11 sectors, while the Nasdaq, founded 14 years later in 1971, includes over 3,000 companies, with a focus on technology and growth-oriented firms. This makes Nasdaq more susceptible to swings in the technology stocks and can result in higher volatility. Market capitalization. The S&P 500 includes some of the largest U.S. companies. The minimum market capitalization is $8.2 billion, while the Nasdaq has a broader range of companies, including mid and small cap companies, making it more volatile but also provides greater opportunities for growth. The performance of the S&P 500 and Nasdaq can differ significantly over time. Historically, the S&P 500 has been viewed as a more conservative and stable investment, with more established companies. The Nasdaq, on the other hand, is known for its higher risk and potential for greater returns due to its focus on technology and growth-oriented companies. In recent years, the Nasdaq has outperformed the S&P 500 due to the strong performance of technology stocks. The S&P 500 had an annual average return of around 10%, while the Nasdaq delivered 14%, meaning 40% more. The S&P 500 is a market capitalization weighted index, meaning that the larger the company, the more weight it has in the index. The Nasdaq, on the other hand, is a modified market capitalization weighted index that takes into account factors like liquidity and free float market capitalization. The S&P 500 provides a more diversified exposure to the global markets due to its inclusion of companies from various countries, which generate revenue from around the world, like Alibaba, for example. The S&P 500 is often driven by broader economic indicators such as GDP growth and inflation, while the Nasdaq can be more influenced by factors such as technological innovation and changes in consumer behavior. Ultimately, the choice between investing in the S&P 500 or Nasdaq depends on your investment goals, risk tolerance, and investment time horizon. Both indices can be used to diversify your portfolio and gain exposure to the US and other stock markets, but they have different characteristics that may appeal to different individuals. The DCA, also known as dollar cost averaging, is a successful and atemporal investing strategy that requires patience and discipline, where an investor invests a fixed amount of money at regular intervals, regardless of market conditions, enabling users to benefit from the potential growth of the stock market over the long term, while reducing the impact of market extremes. Once you have chosen an ETF that fits your investment goals and risk tolerance, set an investment amount and frequency. Decide on the amount of money you want to invest in the ETF and how often you want to invest. For example, you may choose to invest $200 or $500 per month, or $1,000 every quarter. Specialists suggest at least 10% of your liquid income, meaning your gross income minus taxes. The more you save, the more you will have in the future. Simply stick to the strategy regardless of market fluctuations and enjoy the eighth wonder of the world, compound interest.